right, guys. Look, thank you very much. Thanks for the warm introduction, Peter, and thanks everyone for agreeing to put up with me for the next 30 minutes. I'm an accountant. Don't hold that against me. I'm trying to keep things relatively interesting through this, but as Peter said, it is a bit of an information overload, information dump, but there's some good stuff in here, I think, some interesting stuff, and we'll just go through it one piece at a time, and we'll have plenty of time for questions. You just want to keep pushing forward on those slides, Peter. That'd be great, mate, please. I don't think I've got control. There we go. All right, so 3 topics tonight. So first, I'll just give a quick refresh on companies and trusts, what they are and why they're so useful. I'll then go into some advanced structuring. Given you guys are graduates, you probably benefit from that advanced structuring piece that I go through and what I consider could be the ideal structure, depending on what you're doing. And then thirdly, I'll touch on joint ventures and how they really work and why they're so important. That's just a bit of a disclaimer, just saying there that everything tonight's just general information, nothing specific. You would have seen 100 disclaimers, but anyway, there it is. It's actually pretty boring. Okay, so firstly, let's have a quick refresh on why we use structures at all. So the main reason we use structures at all in any sort of enterprise, whether we're investing, we're trading, we're developing, buying, selling, whatever we're doing, is to mitigate risk to an acceptable level and protect assets. So that's the main reason why we do anything. Now, everyone's risk is going to be different. Everyone's risk appetite is going to be different. But I always believe as much as you can, you should be a man or a woman of straw, and things should be owned in entities rather than you owning things yourself. It adds that layer of protection that way. The second reason you do anything, and I have these things are in order, is for taxation purposes. So firstly, you always put or use structures to manage risk. That's the first and foremost. Tax should be, as I've put there, a welcome byproduct of effective structuring. So it's not the main reason we do anything, but if we structure things well from a risk point of view in order to mitigate risk to an acceptable level and protect assets, we should get a welcome byproduct being some effective taxation structuring. And I've just gone on there. Thirdly, another reason why we use a structures enterprise, if you're serious about property, you'll quickly realize you're conducting a business. Serious business people invest time and money on education and structures because they recognize the importance of doing so. And then I've got a little quote down the bottom there that says, "Don't risk it for a biscuit," which is something that I came across quite a few years ago. So yes, it costs money to set up companies and trusts and have effective structuring, and then there's ongoing costs and whatnot. But I can tell you now, I've seen the good and I've also seen the bad when things aren't structured well and the costs that are associated with that. This is my very poor attempt at humour, but I've got that companies plus trust equals poetry, which is probably a word you didn't think you'd hear tonight. But I say there, by using companies and trusts in combination when structuring your property development or any sort of enterprise for that matter, be it on your own or a partnership or with a joint ventures or something, you really can create a thing of beauty and something that's really steadfast and strong. So now I'll just quickly go on to give us a quick refresh on companies and trusts. And isn't it timely that or apt that I've got a Trump quote in there, given what's going on in the world at the moment? No guesses to where my allegiances might fall. All right, so what is a company? So a company, and look, I'll read this verbatim because it's important and I've kept it as concise and succinct as I can here, but a company is a separate legal entity, meaning it has the same rights as a natural person, insofar that it can incur debt, it can sue and be sued, it can enter into contracts, it can buy things, it can sell things, it can own things. Company owners are known as shareholders, and it limits their personal ability to value their shares. They're generally not liable for company debts and other company action, which is a really important factor and a really important reason why people use companies. You use companies to protect yourself and mitigate risk. Companies are registered with ASIC, which is the Australian Securities and Investment Commission, and companies are run by company officers and directors, and they must comply with legal obligations under the Corporations Act 2001, which is the legislation that administers or that regulates companies in Australia, and that regulates the smallest company right through to BHP and others. Private companies generally pay tax at a flat 27.5%, which is actually gone down to 26.5% this year, and it's marching down all the way down to 25 at some point, which is really nice to see. Sorry, Peter, do you want to push that across?
Oh, so you want beyond trusts?
Yes, yeah, just
sorry.
on to the next one. That's okay.
Is that where you want to now, or keep going?
Mine seems to have frozen. I can't see the next slide, sorry.
Oh, okay. I'm on to refresh companies and trusts.
Does it say companies? Refresh what is a company?
So we had
page
companies,
6.
then we had trusts.
I can only see. I can only see.
I'm showing page. Yeah, okay. It's frozen. I'm on page 7.
Bugger. Yeah, I'm frozen on page 6. Sorry.
Guys, can you just let us know what page you can see? Should be a page number in the bottom right-hand corner. Okay, so everyone's stuck on 6, right? Look, what I might do is I'll shift presented to Drue. Hopefully that will solve the problem. So just give me a second. So Drue, have you got the presentation up on your computer?
I don't know.
Oh, actually, hang on.
Here we go.
How's that now?
I've got 7. I can see your mouse moving.
Cool.
Right, we'll keep going. So, refresh, what is a trust? So, again, I'll read this verbatim. It is pretty succinct and to the point, and it covers the main part. So, apologies for just reading. But a trust is an obligation imposed on a person or an entity known as a trustee. So, their job is to hold property or assets for the benefit of others, known as beneficiaries, on trust, which is why it's called a trust. A trust will require a trust deed, which outlines how the trust will operate, and requires a trustee to undertake formal yearly administrative tasks, such as determining and distributing trust income to its beneficiaries. As a trustee is legally responsible for its operations, we always recommend that a trustee be a company known as a corporate trustee, which provides another layer of asset protection. Trusts generally, I say they don't pay tax. They generally don't pay tax. I have seen trusts pay tax, but you shouldn't because the tax rate's ridiculously high. But trusts don't pay tax, rather the beneficiaries do. So whatever money the trust makes or profits that it makes, it has to distribute at the end of each year to its beneficiaries.
Should be showing slide 8 now.
Yep, we've got 8 there. Yep. So we'll just go on to what the common 3 forms of trust. So we've got discretionary or family trust, which we know. We've got unit trusts and then hybrid trusts. So a discretionary trust is this distribution of income and assets is at the discretion of the trustee. They're commonly used as a private wealth vehicle owing to the wide variety of beneficiaries they can distribute to. Hence the word family trust. Usually when we set up trusts, we set them up for people and their families. Unit trusts have fixed beneficiaries or fixed entitlements known as unit holders. So they work a little bit like a company, but they're a trust, and we commonly use them in conjunction with self-managed super funds and property syndication investment, just because of the flexibility that a unit trust can offer. The other reason we use unit trusts often in property-related transactions is for the CGT benefits that they can yield. And hybrid trusts are a combination of the two. Not as commonly used these days. The ATO cracked down on hybrid trusts a little while ago. I mean, we still see them used, but just not as widely anymore.
So I've got a question here from, just to confirm, is it Stephen or Stefan? I'm just going to unmute you, Stephen or Stefan, so you can confirm that for me, because I don't want to keep telling you calling you the wrong name. I've just unmuted you, mate. Stephen or Stefan?
Stephen.
Stephen, thanks, Stephen. I'm going to mute you again now. Thanks. Stephen, all right, so are there limitations as to how wide the beneficiaries can be?
To a degree, yes, there is. So in the trustee or a discretionary trust, you have to pick primary beneficiaries, which are usually one or two or a combination of different people, and then it's from those people that the generations 2 up and 2 down are then chosen. So it comes down to who the primary beneficiaries are, and then the secondary and tertiary beneficiaries feed off the relationships, personal or otherwise, that those primary beneficiaries have. So there is some limitation to it, but there is still a wide variety of beneficiaries that a discretionary trust has access to. But typically it's 2 generations up and 2 generations down.
Awesome. Very handy. Good question too, Stephen. Thanks. But, next slide.
I'll add one other thing there too. A discretionary trust can distribute to another trust, be it fixed, hybrid, or discretionary. It can also distribute to a company as well. So
do they have to be listed as beneficiaries?
No. Typically it will say any company or any trust.
Very interesting. I didn't know that. That's a good one.
Yeah, it's something that sometimes gets.
Can charities be beneficiaries? Question from Stephen.
Absolutely, they can. Yes, definitely. Typically, in most standard deeds, they consider any. They talk about registered charity or registered deductible gift recipient (DGR), and that's a common thing we see come up in trustees all the time, and we've had a few clients distribute to charities over the years. Far better usually to make the tax deduction rather than the distribution, but much of a muchness really.
Yeah, and just to answer one of the other questions, Drue's details will be at the end of his presentation, so be able to grab them there. And yes, he is based in Brisbane. Excellent. So next slide.
Yes, please. All right, so advanced structuring. Now I've said here the ideal structure. Now I consider this, when I say the ideal structure, this is the ideal structure that most of us will use in certain, I guess, in particular property deals. But the idea is to give everyone, I guess, a general sense or general look at how the use of companies and trusts together could work. So as I've got here set up, we've got an entity called My Property Development Co. So in this instance, it's the entity that will provide all the development services to the SPV, which is the special purpose vehicle. And that entity can be used again and again. So you set that company up, and then that company's got some wide use and it's got limited risk. But
sorry, Drue, we actually lost you there for a few seconds. It went to my special, the company that will provide the services, and then we lost you for a few seconds.
Right. Okay. I'll start again. Sorry. So I've set up. I've just going through the structures here. So in this instance we've got 2 companies. We've then got a trustee company and a trust. So I'll start with My Property Development Co. I've just made these names up, of course. So that entity can be used again and again and again, and the idea of it is to provide development services to either the SPV or to other entities in the group. So, and the reasons we do that are for taxation and also for risk mitigation purposes. My special purpose vehicle co in this situation would be the entity that buys the property and develops it, and then we can decide at the end whether we want to wind it up or not. But we can see that we keep My Property Development Co. by stripping costs out of my special purpose vehicle across to the development company. And then we have my trustee company, which is the shareholder in both, it's the trustee of the trust, which is the shareholder in both those entities. And then what that does is that entity then can become a personal wealth vehicle, because its only job is to hold the shares in entities and then eventually receive monies. So I just consider this a really neat, I say the ideal structure, but I think it's a really neat structure for people to use once they start to go outside their first, I guess, smaller property investment when they're getting into the actual development side of things. This is something that we use with clients again and again.
And I think that's a really good point you make there too, in that, you know, guys, we talk regularly about being deal ready, having your structures set up and those sorts of things. But there's also something to be said for building a fortress to protect nothing. You know, you don't need to go crazy about how you're setting yourself up before you've even started. You know, there's no reason that, you know, as in to say, what you set up right this minute does not need to be how you're set up for the rest of your life. To do your first deal, and then your second deal, and start moving your structures and that sort of stuff and developing the system as you go, that's perfectly okay. When we say deal ready, that's obviously be set up so you can do that first deal, but you don't need to have a fortress set up, you know, for your very first deal, if that makes sense. Would you agree with that, Drue?
Yeah, that's right. Yeah, you don't want to have, you know, there's no point having a, you know, 28 companies. You just do things, you know, steady as they go, and make sure that you can, where you can repurpose and reuse companies. But if the risk is not at an acceptable level, then you wind them up. You move on to the next thing. You just consider
And
that
I don't know if this,
cost of doing business.
and I don't know if this is just my experience. I'm guessing it's maybe fairly common in that, you know, you kind of tend to outgrow things, in that the way I was set up at the start worked at first. And then once I got to doing multiple projects and starting to hold some stuff, the way I was doing it had become messy. And then we needed to review how I was doing it. And because basically I'd taken, I guess, the business to another level. But it wouldn't have made sense for me to set it up the way I am now at the very start. It would have been an unnecessarily large cost. And the truth is, we just didn't even know where I was going to end up in 5 years.
And I'll circle all the way back to a comment you said right at the start, Peter, and that's about having a good team in place. So you want to get to the point with your accountant or your advisors that every time you're considering doing a deal, they're one of the, you know, outside of the people you're doing it with, they're probably the second or third person you're talking to, just so that we're fully aware of what's going on and making sure that what you've got now will work, or if we need other entities or we need to make other considerations, we do that. So you really want to get your advisors in pretty early in the piece, just to make sure that they've got a good understanding and a good handle on what you're doing, and that what you've got in place now is going to work, particularly to avoid paying double stamp duty and nasty little traps like that.
Yeah, if you decide to tell your accountant once you finish the deal that you intend on keeping one of the blocks that you've just done a JV with someone else in where they own everything, that's a bit too late for them to be overly helpful. It's the sort of thing you want to plan from at the start. But anyway, I think we've made the point there. We better keep moving on. We're ticking through time incredibly. Any questions on that there, guys? That is a very helpful and important slide, that one.
Yeah, it's a good one to put in the memory bank and consider and look at other times. I think that's really, I say ideal structure, like that is the ideal structure when you're moving on to your next iteration in your journey. You may already have a company as trustee for a trust that you already use to hold other shares. You might have been involved in SPVs, special purpose vehicles, where you've done small developments, but I mean, that in any combination, and it works really, really well, and it can continue to work really, really well regardless of how big your developments get. You just add more things on.
No questions, so we'll keep going.
Great. All right, joint ventures. So I'll touch on joint ventures and what they really are, and also what they're not. So firstly, joint ventures or JVs are not partnerships. And I say that it's one of my pet hates when I hear people talk about their joint venture partner. And it's not that you get upset with people. It's more just it's an education piece. So no one has a JV partner. And while I'd go on to say here, whilst there's a tendency to use this language, it's fraught with some danger. And why is partnerships have joint and several liability, which is the very thing you're trying to avoid in having a joint venture. So if you start talking about a joint venture partner and you're being in partnership with someone, you're not in a joint venture, and that can have some serious ramifications because the joint partners in a partnership are joint and severally liable. JVs or joint ventures is where you're trying to bring, well, where you bring different things to the table. So joint venture means different things to different people, but in any event, people tend to use the term joint venture to mean an arrangement under which several parties come together to undertake a project. So the most common scenario we see involving a joint venture is where one party owns land, i.e. a money venturer, and the other develops it for the landowner to sell for a profit, which is the developer or the development venturer. And typically we see there to incentivize the developer, the landowner may negotiate with the developer such that the latter will be remunerated based on the profit achieved by the landowner on the sale of the developed property. So there isn't a profit split per se, or there may be, but it's not overtly mentioned there, because if you start talking about I'm going to get 20% of profit and you're going to get 80% of the profit, you're actually starting to venture down a bit of a dangerous road, because you're starting to talk about partnerships if you start to talk about profit splits. Now, the joint venture that you undertake in reality might be such that you get 20% or 80% of the profit, but it all comes down to the devil being in the detail and making sure the wording's correct and that there's incentive rather than actual percentages and dollars talked about, I guess. So you just have to be very careful. Probably starting to stray into legal territory a little bit here. But and again, I can circle back to the team. It's always important to have those discussions with your team, with your solicitor around that time, particularly when you're getting
another crucial member. Yeah, excellent. Next slide.
Yes, please.
Yeah.
I think we're coming somewhere toward the end.
Yeah. So we've got. We'll try and wrap it up in the next 5 minutes.
Yeah, that's all right. So, so how's a joint venture put together? Well, parties usually enter into what's called a joint venture agreement, which specifies the rights and obligations of the joint venture parties. Upon the sale of the property, the developer fees payable by the landowner to the developer will be calculated under a prescribed formula. The developer will then be entitled to an agreed percentage of the net profit achieved paid via a development fee. So again, very important that the formula of some sort be present in the agreement so as to avoid partnership ambiguity. So you don't want to stray down the partnership route. You want to talk about a development fee and an amount being paid, not a profit split. I'll go on to talk a little bit more about incentives and whatnot, but I'll end on that there quickly without reading everything out verbatim. It's very important. A true JV is not a profit split arrangement. That would tend to lead to the formulation of a partnership, which again, you don't want to be seen or be a part of if you're trying to achieve a joint venture, because you don't want to be the person that has the most to lose and have the least amount of input, so to speak. So you really want to make sure that you get that joint venture agreement done properly.
And that's the point to stress, I think, guys, is the it can get a bit confusing now when, like Drew's right, in the language that gets thrown around in common speak versus how it actually needs to be written down. So can you do a joint venture and do a profit split with your I don't want to say the word partner now, the person you're doing a joint venture with? In practice, your venturer. In practice, yes, you can. Technically, is that how it's going to be written? No, it's not. So I just want to, and correct me if I'm wrong, Drew, I just want to distinguish that don't get confused now that you can't do those things. Yes, you can, but how it needs to be written is very important. And that's why your team is very important, because if you've got someone that doesn't know what they're doing, that can open you up to other risks. Is that fair to say, Drew?
Absolutely, 100%. Yep.
Excellent. Cool.
All right, so here's a common joint venture structure example, just to give you guys an idea of what it could look like. So in this situation, we've got Property Development Co., which is the developer joint venturer, which provides development services to the landowner joint venture, which in this situation, for whatever reason, is a trust. So we can see that the the landowner joint venture is paying a development fee, and then the landowner joint venturer sells the developed property and makes their profit from that, or makes their money. So this is something that we typically see. I mean, the entities are interchangeable. I just used a trust for this situation, assuming that in this structure here, the person owning the property was looking for CGT benefits. So just again, interchangeable with companies and other entities.
Excellent. And just to answer a question from the previous slide from Manvinder, who is the best to formulate the JV agreement, solicitor or accountant? So that is legal work, but as you can hear, there is accounting implications.
Yeah, I always sort of tend to err on the side of the solicitor being involved, and they've got some pretty good pro formas. There's some particularly good solicitors that Nyan and APS push forward, so I tend to use those guys more than just the accountant. I mean, we've got some pro formas that I've used with clients in the past where, well, once excuse me, I guess once you get to a point where a client's done a number of them, we can provide the document and provide some advice on that, and then let them formulate that between themselves once you get to, you've done a few of these. But certainly your first couple, you want to, particularly when you're doing with people you don't know that well, you want to make sure that your rights are as protected as possible, and you get the solicitor involved to ratify that deed or that agreement.
Also an area of expertise, guys, you don't just go to your regular solicitor, your family solicitor for joint venture agreements. There, from personal experience, there's the guys that don't even advertise that they do them. You definitely don't want one of those. And then there's the guys that do advertise that they do them. And even from amongst those, there's ones that really specialize in it and know what they're doing. And then there's other ones that, well, like anything, there's a scale. There's the experts, and then there's the people that can put something together simple. Yeah, and you've just got to choose the right tool for the job.
No, well said. All right, and this is a second example I've got here of a joint venture with an SPV, so special purpose vehicle. So go back to our development company, which is going to provide all the development services to the SPV, and it'll pay the development fee, and it's what you might call sweat equity, whereas the capital provider in this instance is providing all the capital outlay, loaning any funds, and it also has a loan agreement. And then the SPV is the entity that's going to buy the property, develop it, and then get wound up on completion. So this slide here, when you guys start to go into JVs and talk about joint ventures, this is probably the most common situation you'll come across, I think, and I think you'd agree with that too, Peter, that you see this sort of structure here happening all the time. Now, there can be companies as trustees for trusts owning the shares in the relevant companies here and there, but I mean that's sort of by the by for this example. I didn't want to go down to the director and the shareholder level. I just wanted to give you guys a pretty good sort of, I guess, helicopter view or understanding of how most joint ventures work in practice, which is this slide here.
Yeah. Excellent. Any questions on that, guys? Actually, sorry, we have some here. How does the developer secure their interest in the outcome of the joint venture if you don't own the property?
That's a good question. You can't. You take the risk. So
yeah, that's yeah, it's a very good question, and yeah, it's there's certainly it's one of those things where if you want to remove all risk, you also remove all flexibility. And development is something that requires flexibility. So there are certain ways that you can protect your interests, like having yourself as a director have yourself added as a director to the special purpose vehicle and various other things. But at the end of the day, there certainly does need to be trust, a certain level of trust between you and your partner. I think the overall way of simplifying it is if you really went toe to toe with someone, whoever holds the title is going to win. Yeah, that's probably the simple answer. So
yeah, and they've
obviously,
and
oh, sorry,
holds titles. You're right. Sorry to jump in there, but whoever holds titles probably going to have some sort of bank funding as well, or some other monies that they've loaned. So they should be getting, theoretically, well, yeah, they should have the most. Well, they've got the most at risk, so they should have the most protection. Whereas in some ways, you can argue that the development or the developer entity really is just providing their services and getting remunerated for them.
One of the best ways to protect yourself is to have fees coming while the project is going. So not everything waiting to the end. So taking some of your profits as it goes, as a weekly or a monthly project management fee, for example, because once it's in your account, that's much safer money.
Yeah, possession's 9/10 of the law, as they say.
Yeah. Yes, exactly. And one more there. Do you reckon, Steve? Yeah, trust. Yes, it's I say inverted commas trust. You still got to do everything you can to protect yourself, but you got to accept the fact that there is no zero risk project.
No.
Do you recommend any solicitor firm in Brisbane? Look, what I'd suggest with that one is just send an email to the office, and Young will send you through a few suggestions, or the girls in the office will send you through a few suggestions.
Yep. Yeah, definitely.
All right. Well, we better wrap this one up now to keep somewhat on time. Is there another slide here? Oh, no. Perfect. Any final questions for Drue, guys? Oh, now I lied. I said your details would be on the end. Are they here somewhere? Oh, there we are, in the next page.
Yeah, there we go.
Yeah.
So numbers there, mobile's not there, but my email address is drue.schofield@forefront.net.au. Google Forefront, Google me. You'll find my details on the internet somewhere. Or ask Nyan and he can pass the details on. Or the office.
Yep. And just for